Economists often make mistakes, but Ray Dalio is not an economist. He's a fund manager with billions of dollars at stake and thousands of clients. Dalio earned billions during the dot-com bubble and the 2008 collapse, but now he's preparing a monstrous short position that will boggle your mind. This time, Dalio is going all in and can't afford to lose money, therefore you should take him seriously. He recently revealed a $10 billion short position in Europe, and he's likely been building a larger short position in the US market as well. Today I'm going to talk about 3 reasons why Ray Dalio has bet on a global collapse. Don't miss number 3 if you want to know why he thinks this recession is different from the 1920s and 1990s bubble. Number 1, stagflation. Right now, we are in the worst kind of crisis, stagflation. Stagflation occurs when the economy is weak and inflation is strong at the same time. Inflation has surpassed 8%, while GDP has fallen in the most recent quarter. This is awfully stressful because stagflation usually develops just before a recession. Ray Dalio has monitored the economy over the past few centuries and found a pattern. The cycle often begins with an increase in government debt, which improves the economy in the short term. This may appear sensible in the short term, but lending is a two-way street with creditors and debtors. The creditor is the person who lends the money, and the debtor is the person who receives the debt. When there is too much debt in the system, both sides of the transaction cannot sustain. This is due to the fact that one man's debt is another man's asset. When a creditor lends money, they are lending assets. If the debtor incurs excessive debt, this indicates that the creditor lacks assets and will understandably desire to acquire additional revenue. The main issue is that when debt levels are too high, debtors don't have the funds to repay the creditor. This will force the debtor to sell assets in order to pay off the debt. Evergrande, a Chinese property developer, was forced to sell properties to pay off its debt. When this happens, the economy will crash. When the central bank notices a weak economy, it will print money to keep the economy from collapsing. While printing money may work in the short term, it causes long-term complications. By the way, are you enjoying this video? Please give it a like and hit the subscribe button if you like content about business, economy, and crypto. It really helps me grow the channel. Money is nothing more than paper that is meant to represent value. When the worth of that paper is diminished, its value will definitely drop. So when the central bank reduces the interest rate, prices begin to skyrocket. At first, the debt levels grow excessively high, and then debtors default, which puts the whole economy in danger. And that danger will force the central bank to print money to boost economic activity. We have had the same underlying problem of a weak economy throughout this time. The only difference is that printing money introduces a new demon of a problem, inflation. We are currently experiencing stagflation because printing money does not stimulate the economy in the long run. We have a weak economy and excessive inflation. The next phase in the cycle for the central bank is to slow the economy by raising interest rates. Dalio has seen that in the past, and doing so virtually always leads to a recession or depression. There is no way to stop it from happening. If the government continues to print money, the problem of inflation will worsen. The only solution to stop inflation is to reduce demand, which is done by withdrawing money from the economy. In other words, stagflation is the intermediate state between the height of a debt cycle and a significant economic downturn. According to Ray Dalio, we are currently experiencing stagflation, and the next phase of the cycle is a recession or depression. Dalio has indirectly talked about 2 different types of money, commodity money and fiat money. Commodity money is money that gets its worth from its substance. Consider gold. People have used gold for transactions for generations. Consider gold. People have used gold for transactions for generations. This is because gold has tremendous value as a scarce metal with unique chemical characteristics. Fiat money, on the other hand, is money that is backed and issued by the government. The US dollar is an example of fiat money because its value is solely set by the US government. In 1971, a massive shift happened away from fiat money and toward commodity money. Stagflation puts economies at risk of losing their fiat money, particularly if the government continues to print money. Zimbabwe's 2008 hyperinflation is a classic case of this. Because the government kept creating dollars, the Zimbabwe currency faced daily inflation of 98%. Fiat currency has value solely because people believe in it. If people lose faith in the US dollar, its value will drop. When the dollar falls in value, more individuals become doubtful, which leads the dollar's value to fall even further. Number 2, the Fed. The Fed is really worried about this positive feedback loop. So how bad of a recession are we talking about here? Well, Ray Dalio has summed up the solution in a car analogy. Consider what separates a good and bad driver. A good driver would softly push the gas and brake pedals, leading the car to go forward at a reasonably steady speed. There will be external circumstances outside the driver's control, such as traffic lights and pedestrians. However, as long as the good driver prepares ahead of time and slowly eases on the brake, the passengers will have a smooth ride. This is how most people drive, but a terrible driver would slam on the brakes and the gas, which leads to abrupt changes in speed. Such a journey would be unpleasant for the passengers, with the car constantly wobbling backwards and forwards. Dalio thinks that the Federal Reserve has been a bad driver. In 2021, they slammed on the gas, causing the car to skid forward. They are in the midst of hitting the brakes, forcing the car to lurch backwards. In 2021, the Fed printed money at a rate of $1.5 trillion annual rate. This brought in a 25% increase in company pre-tax earnings, the biggest increase since 1976. Post-tax company earnings climbed even higher by 37%, which is the largest increase since 1948. The Fed is currently reducing the money supply at a $1.1 trillion annual rate. It is not a mystery that we are going to face a crisis of such enormity. In the 1970s, the United States had two recessions, the first in 1974 and the second in 1979. The only reason the United States weathered this storm was due to Fed Chair Paul Volcker. Volcker raised interest rates in 1979 to combat inflation. As a result, the economy saw unpredictable swings, and the GDP was primarily declining throughout Volcker's term. However, other countries suffered considerably more than the United States, which means Volcker's decision proved correct. Debtors from other nations were forced into 10-year depressions. Dalio explained this, saying how inflation was reduced by companies and consumers being painfully squeezed and cutting back on spending. That's always the case, and will be the case this time. As I said earlier, the capital markets overextended in 2021 because of money printing. Dalio knows this because of his bubble gauge, which he uses to determine whether or not stocks are overvalued. Dalio has his own bubble gauge, as seen in this graph that categorizes bubbles into percentiles. The 1920s were a time when the bubble gauge reached the 99th percentile of bubbles. In the 1990s, the same thing happened. It stayed in the 99th percentile for several years and then collapsed. Before the current crash, 2020 was in the 85th percentile of all bubbles, but it is now in the 40th percentile. So according to Dalio's metric, stocks are significantly undervalued. According to Dalio's metric, the bubbly businesses have actually fallen below the mean. Number 3, the future. Keeping all that in mind, Dalio believes the bubble stocks will continue to fall. The 1920s and 1990s were very similar to the 2020s. Therefore, Dalio is making a prediction based on history. Because of easy monetary policy, the valuation of growth stocks increased dramatically in all three periods. This enabled him to analyze previous patterns and make a prediction. Dalio showed the 2-year Treasury bond yield in the Nasdaq for all three periods. In comparison to the 1920s and 1990s bubbles, the current one has more downside. The leverage gauge is another tool that Dalio uses. His leverage metric analyzes the market's options, positions, and margin debt. As of right now, the leverage gauge places us in the 50th percentile of the dataset, which is fairly average. This can lead some investors to believe that there is little to no risk, but Dalio doesn't think so. He has observed that bubbles frequently overcorrect, which brings us back to the car analogy. Similar to how the economy swings back and forth, bubbles often swing more than the fundamentals indicate. The market's leverage is currently near average, which may seem okay, but bubbles generally overcorrect to the 20th, if not 10th percentile. Dalio is set to pocket billions of dollars from the inevitable correction. That said, considering his European short position, I wouldn't be amazed if he did. Not only that, but Dalio also thinks that in addition to a recession, the United States faces a 40% risk of a civil war bursting out. But that is a topic for another day. Let me know what you think about Dalio's strategy. Have you managed to safeguard your portfolio like Dalio? If you learned something new from today's video, click the subscribe button and hit the bell icon to be the first to see my next video. I make deep dives like this every week where I uncover the secrets of money and business.